again. Here we are. Hopefully you can see the trading screen now.
Yeah, all good.
And the net account value is 192,000. We've got 160,000 in cash waiting to pull through to the net liquid value. And the stock buying, so there's 174,000 plus in stock buying power. So that means we have got 80,000 of stock buying power to trade with. So we're in a good position there. These are the shares that we actually own, quite a lot of them. So we're going to I'll go across this sheet and explain what's happening with them. So we've got the ticker symbols, and then we've got paid. That is the strike price that we promised to buy these shares at, and which we were asked to fulfill that promise. And next to that, you've got the current prices. And the current prices are generally below the paid prices. That's because if they get higher, then I tend to move them on pretty quickly. Then we've got the number of shares, and then we can see how much we are. Make the red one stand out. There we go. All nicely red, apart from Enable, which we got for free anyway. Then we've got how much we got for making the promise. If we've sold any calls, and there's one CMCA where we sold a call and got 63 cents for it, that comes into it. And then we've got the net position, including the put income and the call income, and that's the net amount that we're exposed at, basically, and that's how much they're above or below water by. So a lot more of them are above water when you take into account the income that we've had, but they're still a little bit below, but generally we're not too worried. We'll have a look at the worst case one shortly. So then if you multiply the amount per share that we are above or below water by the number of shares, then you get to see where we're at. And overall, we're slightly up, 2,300 up. The next calculation tells us what we would need to do to get it in the black per share. It's obviously the same. So that is taking into account the money that went out to buy the share, the money that would come in at the current price if we sold the share, and any put income and call income. So in order to get in the black on this one, the top here says CNDT, we would need to improve our position by at least $2.82. The next one is the forecast, and that's the forecast that basically comes from Sunday night that Owen's webinar puts forward. Then we've got two value line forecasts. So we've got one that looks at 18 months and one that looks at 3 to 5 years. And after that, way to the right, I'm looking here at comparing the strike price, so the amount that we paid minus the forecast. So in the case, and I've ranked these in sort of worst to best order. So in the case of CNDT, even if the share price was to rise to its forecast, which is only in this case $7.50, so it's come down by a lot, we would still be $5 underwater, so that's no good. At the other end of the scale, on Sage, we've paid 51, it's currently at 40, we've had $8 in already, but it's expected to rise to 80. So if it does rise to 80, we're $29 per share to the good. So that gives us some work to do. First of all, we've got to get out of these red positions. And secondly, we want to try and make some money while we're waiting for these shares to rise by selling calls on them. So let's have a look at the worst case one. So That's probably quite low. We'll have a look. So I'm going to see if we can get $2.82 out of CNDT. This is going to be fun. I might not be able to do this. So I'll stop sharing that and start sharing the trading platform again. We'll look at the option chain. It was CNDT.
These were shares we own, Jeff, yeah?
Yes. They're all ours, yes. And we need to give it some time. So I'm talking about April. And we are looking at $7.50 as a new strike price. So we bought them at 10 last time. This time we only want to go in at $7.50. And the price available to us on that is $2.50. Well, that's not enough. We want at least $2.82. So we've got two choices. We can wait, let the price rise towards the forecast, which was $7.50, and then we'll get more money for the put, or we can just say no, we'll go forward and we'll do it with $10. So we would have bought the share for $10. We'll sell it for the current price, which is basically $5. So we'd then be $5 down. We'd pull in the income that we've already had plus a further $5, and that would put us in the black with it. So we can do that anytime we like. However, I think it's better that we wait in this particular case, because I would rather we were owning the shares, having purchased them at $7.50. Agreed?
Yeah.
Yeah. So go back to
forecast price, yeah.
Yeah. So let's have a look at the next one. We're not going to do all of them, but we'll find a decent price one. Yeah, here we go. PAA, that's Plains All American Pipeline. So we've paid 18. It's basically at 11. We've had $7.90 for it, and we're actually above water now. That's no good. We're 82 cents ahead on that one. Try another one. Here we go. Hawaiian Airlines. Hawaiian Airlines. We paid 28. They're currently worth just under 20. We got $4.60 input income, and we need to get $3.72 in order to be in the black. And the forecast is that they will get to $24. Now I have a memory test, we have to remember them. Okay, so let's see what months we've got available. April should do it. February's a bit close. July's a bit far off. The forecast is 24, so we want to be below that. And we needed to make, I can remind myself without resharing it, we needed to get 372. So the alternatives above 382 are basically, we can go to 23 or 24. We get an extra 80 cents for the 24. But let's see if we can negotiate a bit on that $4 and see if we can do something with it. And I need to just check again how many we actually had. 200. So let's see how we can get on with this. So you'll notice I'm looking at the bid prices. So we have a bid and an ask. And when we are buying anything, we pay the higher price. When we're selling, we pay the lower price. So in this case, we've got 430 by 4. So click on that and it opens the trading screen. We've got 200, so it's 2 contracts. April 23, and it's $4 by $4.30. So I'll try first of all and go halfway. Now it probably doesn't trade in 5-cent intervals, it's probably 10. And when I click on to verify it, we'll find that out, and we'll also see what the live prices are for this option. Yes, it is saying it has to be divisible by 10, and the gap is actually slightly narrower. It's $4 by $4.20. So we would probably only get the 410. And we did. Okay. So now we need to go back and sell the share. 462 by 465. And we can see that the price is 467 by 469. So we'll cancel that and go for a couple of cents more. And we haven't got it yet. So we go to the orders. And there it is. And because we're working in single cents, we can use the little up and down arrows. So because we're selling, we're going to go down until we get the price that they'll accept. And I just hesitate a moment. Sometimes it takes them a while to get, there it goes. There it goes. So there's the execution price, 1966. What did we pay for them originally? I'll tell you.
29, I think, is it?
It was 28.
28.
So the calculation is minus 28 plus 1966 plus the put income that we previously had, which is 460, plus the premium that we've just got now, which is actually on there, plus 410. There we go. So we're ahead only by 36 cents even on that, but it's actually put us ahead. And that's why I don't particularly want to do it all of the time. I like to wait until the prices are right, but I wanted to also demonstrate it. So let's go back to the portfolio. So I won't take that off there for the minute. I want to make notes next to it so we know what we've done, because if we close that new put early, then we'll have cost ourselves money. So we don't want to do that. We want
Jeff, do we need to go and put a lid on that put before we finish?
Yeah, we do actually.
The new one?
We do. Well spotted that, man. Yeah. Yeah. So what we actually need to do is to cancel the old lid first. So we're in orders, Hawaiian Airways, and there wasn't one. There wasn't one, but that's all right. There soon will be. So then we go back to HA. There it is. Click on that. We switch it to be buy to open. We want to be one strike price down. So that is going to. It was 23, wasn't it? So 22. Yes, to 23. So we've actually come. The big thing is we've come down from having paid $28 for it to pay $23 for it. So that's actually very good. So the new lid is at $22, and we got 410. So we'll give them 40 cents for it. Don't even want to give them that. I'm going to give them 35. And that's that done. So what that will, not that we're short of buying power, but that will also release a bit of buying power as well. Okay, so that's that. Go back to the spreadsheet again. I want to look at the puts that we've got that are expiring. So those, basically, I just watch them, and when we get a decent price for moving these ones on that are at below the forecast, then we need to do something with them. The rest we can wait, and also keep an eye on them and see if there's anything better we can do with them. What else have we got? So here's January's puts, strike prices, current prices, number of contracts that we have, the premium that we got for it, the exposure when you take into account that premium, or whether we're behind or ahead with it. And we're doing all right. So we're 4,700 ahead here. We've only got 3 that are in the red. One is BBBY, and that's at an incredibly high strike price of $32. So,
Jeff, is there any chance you could share the screen again?
oh, sorry. Thank you for pointing that out. I assumed I had. Yeah. So we're saying the strike. People still come in. The strike price, the current price, that, by the way, is linked to the stock market. So these prices, although delayed, are fresh. So that's the current price, number of contracts that we've made the promise on, the premium that we got for it. There are no lids. Sorry, there are a couple of lids. We've got 3 with lids on already. We'll have a look at them. And then we'll look at the exposure and the gain. And as I said, there are only 3 that don't look so good. Now, the first one is BBBY, bed, bathroom, and beyond. And we've already actually taken some action on this. So that's why we've got 2 of them. So we've got bed, bathroom, and beyond at $32. And then we've got bed, bathroom, and beyond at $17. And we've got 3 contracts of the 17 and 1 of the 32. So that is a way of dollar cost averaging. So we are looking to get to an average price, which is going to be well below that 32. Plus 32 equals divided by 4. In fact, it'll be $20.75. So that will reduce our exposure anyway, down to $20.75 from 32 on that one. And we've obviously got 2 lots of premium. But when we actually get them, then I suspect it'll be a candidate for being moved on pretty quickly. What else have we got? We've got JetBlue, the airlines, where we're only 78 cents below. That one was 9.65, so 78 cents below is not going to be a problem to us. The figures right over under P here are the forecasts. So it's forecast to rise up to 20, and we've paid 20 for it. It's only at 14 at the moment, so there's plenty of scope there to do something with that. If I sell 1 call, we'll be out of that. Viac, we've paid 50. We tend to be a bit bullish before sort of December. Some of these, I don't think we do them now. So we paid 50. It's at 36. We got 11 with $2.91. We've only got 100 of them, so it's only $291. But again, we can soon make that disappear. So, but we've got here 3 of our trades where the lids have clicked in. So we've got CPB, which is Campbell's Soup, and we paid 47. The current price is 46.25, and we've got a 46 lid. So what will happen there, unless these prices change, and it might, if that current price goes down to under $46, then the shares will be put to us at 47, and they'll be sold again at 40. We'd get 46 for them, the trigger price. And we'd have kept the premium as well. So we can't lose on that. If it stays where it is, 46.25, then we'll have the shares put to us at 47. They won't be sold automatically. We'll have wasted our 40 cents, wherever it is on the lid, but we'll have had $7 in premium. So even if we sold them straight away, we would make $6.25. So there's no way we're going to lose money on that, whatever happens to it. Geo, the next one, we've got the lid has triggered on that, and it's a $7 lid. So we paid 8. If they're put to us, which they could be at the moment, for $8, they're only worth $7.33. If they go below 7, the lid will kick in and sell them at 7, and again we'll keep our premium. And if they stay where they are, we'll just end it with them and keep the premium. And if we want to, we can sell them immediately and be in profit. And then we've got the last one, which is Vivo. They're all close, aren't they? So we've paid $22.50. Current price is $21.05, and the lid is at 20. That's because it's got strike price intervals of $2.50. So some have $1, some have 50 cents, some have $5, and so on. So we've had to take a lid that was $2.50 below the strike price. So it's unlikely to go down below 20. So they'll get put to us at 22.50. We've had $5.10 anyway, so if we want, we can just sell them, and that would be that. Now, that might be an opportunity. If we go back to the trading screen, we could see that there's an opportunity to sell the lid on Vivo because it's probably not going to be used. So you've got to remember in this, everything is for sale. So you put a protective trade in place. Hello. You put a protective place in trade in place, but you can actually sell it. Not on this occasion though, because here it is, Vivo. It's green and it's got a plus sign in front of it. That means it's a put that we have bought that gives us the right to sell the shares at 20. But at the moment, we would only get 5 cents for them. I think we could try and negotiate, which that would be less than the cost of doing the trade. We'll just have a sneaky look and see what the live prices are. See if we can get them to give us 30 cents. I didn't think they would. It's too close. They're not going to be of any use. I'll leave it. It's a limit order now. If something mad happens over the rest of this week, they might give us 30 cents for it. Okay. So the next thing I want to do is we'll look down the profit and loss column and see if there's anything that we want to take profit on. So what we're looking at here is the difference between the average open price, which is in this first one, $15.60, and the ask price, $13.10. So if we were to buy back our promise now, we've promised to buy these shares for $100. We got $15.60 for it, but we could buy that promise back for $13.10. Hence, we would have made $2.50 on it. If you want us to make $2.50 times 200, we could. But let's have a look. The price is $87.90. So the chances are that they would put this stock to us and would have to then mess about getting rid of it. So actually probably might be worth taking our $2.50. Do we think?
Yes, Jeff.
Have I ended it?
Yeah,
Right.
hi, Jeff.
We're just going to take our $2.50 back or see what we can get for it. So we're now buying the close, and we've got 2 contracts, and the ask is 13. It's actually it's going down. That's good news. That's good news. So let's see if we can get down to. We'll start at 12.50. So we're buying back. So we want to pay less than the prices here. And there we have it. So we paid $12.60. So we got $15.60 and we paid $12.60. So we made $3 there. So that was good. Hello, yeah.
Yeah, that's great. So that's $3 times 200 shares, isn't it in total? Is that right?
200.
So that's $600.
Yes. Yeah.
Brilliant.
Instead of having to manage the share. It's forecast to go up to 100, but it gives us buying power back. It gives us some profit. Now, you never go out of business taking profit, is what we say.
Sure. Yeah.
So let's have a look. What else? So what else have we got? We've got one there, but it's February. So that one we've got 520 versus 330. So there's no need to do anything with that yet. Let that continue. That's still a bit low to do. November 25, November 20,000. That's November. That's a long way out. I'm not going to do that one yet. Bed Bath & Beyond, we're happy to take the shares to balance out this one. Here's a candidate. It's sort of 50% in profit. So we got $4.51. If we want to get rid of it now, we'd somewhere between 235 and 220. But it's a March one, so we don't have to do it now. We can let that rise. 85% is the area where we like to try and do it. That's before the lid kicks in and costs us money for the lid. Cardinal Health, there's a couple of dollars worth in that, but it's March again, so there's no rush. Here's a January one. That one isn't in our favor at this point. Oh, that's a stock. Here's one. Here is one. Now here's so now that this one, I'm looking at Campbell's Soup here in the middle. So this is the position on this is that the share price is, it was in between, isn't it? So it's CPB. Where's it gone? There it is. It's 46.17. So at the moment, these shares will be put to us at 47. They won't be sold at 46, even though we bought the lid, because they need to be under 46. The share price is pretty close anyway, so it's not the end of our world. However, if we wish to, we can just buy back our promise. So we've had $7 for it, and we can pay about $1 or even a bit less for it. That looks like a likely suspect. And we can also have a go at selling the lid back as well. There's 30 cents in that. That sounds like a plan.
Definitely.
So it's only 100, but it's it's 600. It's $600, and so we want to pay a bit less. So let's start at 90 cents. And here are the current prices. We're not going to get 90 cents because the price has gone up. We will try 105 and probably won't get it. Yeah, I know. I'm just being cheeky trying to get it. You won't get it if you don't ask.
Yeah, wobber. Yeah, wobber.
Yeah. How man gives it? There we
Hey.
go. So we got $7. We've given them 110 back, the $1.10 back. And we've also got the potential to sell the lid back, which is this one here. And so that's looking, no, so I don't know if it'll do 5, it might do 25. So that would be $25, isn't it? The cost of the trade is $14.95 max. So if we can get that, we'll just make $10. And the price is higher, the live price, so we'll actually go up. So we'll go up to 35. You see, if it goes through straight away, I always think I'm giving them something away. So it's I don't actually like it to go through. So what are we doing? We are selling to close, so we go down on the price. And there it is. So that's so we got 30 cents. So effectively, we paid 90 cents back overall, having got $7 for it. So 100 times $6.90 is where we're at on that. So that was CPB. What else have we got? Back to the portfolio.
$680. Nice.
Aye, it keeps going the right way. CPB, so we're down to here. They're tiddlers. It's June, that one. There's a couple of dollars in it, but it's still June. We'll get more than that from it. Here's another January one, FLR, and it's 770 minus 480. So there's 200 of them. So.
Isn't it January 23 though?
Oh, sorry. Cassie, you always know it's a 23. My eye only picks up the January. Well done. Thank you. Yeah, so we'll let that go higher. We don't need that back yet. Now, yeah, Geo, this one has got a lid on it, which we know already we can't get anything back for that lid. But we only got a miserable $1.60 for it. And what's the current price? Geo, there it is, $7.32. I think I would be tempted to allow the stock to be put to us and then to sell a call, an $8 call on it. And that will avoid paying here to get it back. So I don't know though. It's gone down. The price went down then. So there's 80 cents. The question is, would we get 80 cents when we sold the call? No, we wouldn't. Not on an $8. I don't think. What do we think? Any views?
You don't kick that one out, Jeff. Can you do that?
I can kick it out. Yeah, that's what. Yeah. So it'd be by the close, 75. We actually go less than that. We would try and go for 70. Yeah, 6 contracts. Yeah, filled. Oh, look, I must have given it away cheap. Yeah, I'll just check out this one. It's only 5 cents. We're not going to get that. Verify and see what the live price is. No, there's no chance. So that one will just expire useless. That was Geo. So we made a few bob there again. Gold is a share. Here's a gold one. That's due January 22. That's it's forecast to get to 25. It's only $1 and sort of 10 cents.
Better just leave that one away.
Yeah, it's not worth. We'll take it and let the share rise a bit. We'll be able to sell a call on it. What else have we got?
GBLU.
Oh, before that we've got INSEE.
All right. Okay.
So INSEE, we got 1786. We could have it. We could give them 1460 back. Let's have a look. INSEE.
320.
INSEE. Yeah, it's actually forecast to rise substantially to $88 this. And it's currently, it's in HIJ. Yeah, there it is. Oh, it's currently 70, 75, 71. Still quite a gap to close, isn't it?
It's not going to happen this month, I don't think, is it?
Well, it's not going to happen this week. Definitely not.
This week, sorry, that's what I meant.
Yeah. Are we okay with getting rid?
What's it giving us? $3, Jeff?
Yes, the difference between, what was it, INSEE, the difference between 1786 and then on whatever we get. So 17.
$3.16.
Yeah, let's think. We'll certainly be trying for 1450.
So it's another 600, isn't it?
Yeah, yes.
Is that the only time you do business, when it's 600? Is that right?
Yeah, that's the rule. That's the rule. So we'll try 55. We've got two. We've got 62, 50, and 60, and the current price is oops, it's behind someone's head. 54.43. 54.43. So with that one, there's no point in us doing anything. Sorry, there isn't a 54. I'm sorry, I thought it was 54. So it's 54. So we're going to be sort of $6 and $7.50 underwater there. However, we did get $8 and $10.88 for it. So we're not underwater overall. It's just a question of whether we want to live with it and make more money off it, or take profit now.
What's the forecast on it, Jeff?
The forecast on Intel, let's have a look. There it is, 68. 68. So, and it's at
54.
54 now. So, you know, it's not the end of the world, is it?
Would we push that out then and let it rise?
Well, we could try and roll it forward, or we could just accept the shares and let it rise. Either way, we don't seem to get very good premiums at the moment on pushing forward. But let's have a look at it on this on the higher price of the two. So we're going to add an option, and that would be a sell to open option, and we want two of them, and we'll go out to April. Give it plenty of time. Incidentally, these 14th of April is the Thursday before the Friday of Third Friday, and that's because the Third Friday is a public holiday, or it's Easter or something. Well, that will populate itself. We have to populate this one. 62. So we're buying it. We pay the higher price. That would be $9.20. We sell it. We get the lower price. So we'd actually be sort of 10 cents down on it, which is there's a bit of scope for negotiation, but it's not worth doing. The transaction costs wouldn't make it not worthwhile. So the choices are: take it now or let it ride. We got to let it ride and make some decent money. Yeah.
Yep.
Any objections to letting it ride? Right then, JetBlue January. That's not in profit yet, so we can't do that with that. We have to wait till we get the shares. What else have we got? That's June, April, January 22. Newmont Mining. Here's a nice one. So Newmont Mining, there it is at 64.14. And we've promised to buy it for 70, but we have got $7.65 if we want to take it. I suspect we do.
Yep, I love that.
Now then, so we are buying the close, so we want to pay less than the 6 if we can. Well, I've just put it, I don't know if it does 5. We'll find out if it does 5. It does, and we might get a bit better off here. So buy the close. No, we won't. They're going to want sort of 5.75 or something. Yay! So we've paid $5.80 to get it back, having had $13.65 to start off with. So I think we're happy enough with that. So we go to orders and cancel the lid.
Was that two contracts?
Yes, it was. Yes, it was. Yeah.
Oh, that was a good deal.
How much is that then?
So what do we get in the end?
13.65 minus 5.80.
Oh, nice. 800. So what's that? 1,600 quid, is that right?
Yep, yeah, it will be.
Cha-ching.
13.65 minus 5.8 equals times 200 equals 1570. And cancel the lid. Okay. That was Newmont. That one's still underwater.
Veil.
SLV. It's March. We're all right. Give it some time. And Vail is another January one. Vail's all right, I think. Let me just check the price on Vail on the chart. 16.17 and rising. So 16.17 and rising, we've had for $6. Yeah, I think we can live with that one. Okay, so that's changed a few things around a bit.
So will Vale be put to us, Jeff?
Yes. Well, yeah, because we've promised to pay $20 for it, and it was at whatever I said it was. It was at it's only a 16.17. So somebody will want to get $20 off us instead of 16.17.
Yeah.
But our effective price on it is $20 less the premium, which is like nearly $6. So effectively, we're paying 14 for it. So even if we sold it straight away, you know, we'd be okay. Right.
So 300, yeah. Okay.
Yeah. So we've got we've got plenty of money. The stock buying power is now up to 183. So we've added to that. So we can have a look at selling a few new ones. Right, the first one that I'm looking at. So I've been through the process. I went through all of the forecasts that we got from Sunday night, and also the value line reports. I also looked at whether the risk to reward ratio was high, medium, or low. I've looked at premiums. I've looked at strike prices, and I've looked at the returns if the stock is put to us or isn't put to us, or if we close it early. And having done all of that, I've then ranked the potential trades from sort of best to second best and so forth. And the best one that we have scope for without breaching our 5% of the value is Fossil. And here it is, Fossil. You can see that? Can you see the charts?
Yep.
Yeah. So, yep. And the value or the price I've got in mind is about 15, so it's about there. And it is forecast to get up to let's have a look, 16. So that's a bit high. So I would rather go below 15 if there are any strike prices available. When it moves, for that's the sort of level we want it to move, it takes about a month. Sometimes, you know, do twice as much as you want within a month. So let's see on Fossil what's to be.
13 looks good, Jeff, doesn't it?
What does?
13?
Yeah, it depends what's available, doesn't it?
Yeah.
Strike prices. So we've got the option chain for Fossil. We're going on January, that's this week. So February's probably a bit close. June's a bit far away. I think that's a month from the next meeting. So let's have a look. There. And there's single strike price intervals, which we also like. And
is that not February, Jeff?
I would have picked it up on the trading screen. Right. So there is 13, and it's $2.90, which is nearly 10% of 13, isn't it? It's not terrible, and there might be a bit of negotiation. It's $2.90 by $3.30, so we might get 3 or $3.10 for it. Do you prefer the 13 or the 14?
The thing about 13, Jeff, is just the way the paths were of the tickers, you know. It's been at 13 about 3 times in the last 8 months or so.
Okay. 13. And also 13 has got a bit of time value in it. So 13,
it does,
yeah. Right. And so we need to work out how many. So we look at the value of the account. And the net liquid value is 192. 5% of that is 9,600. So 9,600 divided by the strike price of 13 is 738. I don't think we want 7 contracts, but we certainly can. I think if we go for 4 contracts, if we needed to do anything with it, we could dollar cost average, for example. We've got some headroom to go at. Okay with that?
Will we get 3 out of it, Jeff?
Sounds good.
Yeah. So we'll try for 310, see where we get. On the basis that we don't like to actually get it. No, see, good news. That's because we've already got a pending order in. So let's have another look.
Jeff, you put 30 in rather than 0.3. Did that make a difference?
Try it again.
You put 30 in there, 30.0 rather than 0.30.
That would make a difference. But that, all right, so 0.30. Let's see what's in the fossil orders. No, I don't understand why it's not accepting that. I will sort that out later. Okay, next I have, let's have a look at what we got. We've got a BlackBerry. BlackBerry's nice and low at the moment. We don't have any. So let's see what's, so first of all, I'll show you the chart on BlackBerry. And there it is. So this thing, you know, for quite a while, and that was abnormal activity last year. So that, you know, that we can basically ignore that. It tends to just sort of go, you know, $2 sort of up and down, bounces off 12, goes down normally as far as 10. It's gone a bit low this time, 9. So let's see what premiums it has, and we can look at March. So we think it will get to 12, and it's only at 9 at the moment. We could certainly go for 11, where there is $2.22 available, and if it came to us at 11, I'm sure we could sell a good call at 11 and get some more money from it. So it's a good one just for making. It's nice to own because you can generally make money off it every month, whatever's going on.
It's at the bottom of its range, really, isn't it, Jeff?
It certainly is. It certainly is, and we've got scope for 8 contracts, which makes it worthwhile. And I'm not concerned about going as high as 8 because they're only like $11 anyway compared. I mean, stocks where we've got $100 on them, for example. And it's also another useful thing about it is it's single cents on the bid and ask, which is unusual. It's not just the strike prices are single dollar intervals. The range on the bid and ask is single cents, so that's good. So we might as well try and go for 225.
Just a wee drip roast, isn't it?
Yeah. And the other thing before I press this button is, I should tell you, I don't normally bother with a lid on this because the worst that's going to happen is it's going to go down by $10 or whatever. It's just it's not going to create a lot of buying power, and it's not going to give us a lot of protection. It's just going to cost us money.
Because it's such a cheap share, Jeff.
Yes, yeah, exactly. So the live price is higher still, 226 by 231. So we'll try 228. Every little helps. The Tesco policy. So 1,824 for that. That'll do. If we can get it. No, we can't. But
coming in the earnings as well, BlackBerry.
They'll be all right. They are completely cash rich as well.
Yeah.
Where am I? Want to be in orders, and I want BlackBerry. Here it is. So we are selling. So we come down 1 cent at a time. There it is. So we got 127 for it. Very nice. Okay. I think we'll leave it there. There's a few more that I'm watching, but I really just want to show you it happening as much as anything else, and then pick the best time to do it. And I've got another meeting coming at 7:30, so I'm trying to get a cup of tea. Are there any questions? Are we happy? Are we happy with how that's going?
Yeah.
Yeah.
Made about 3.5 or something there, Jeff. Yeah.
Yes. Yeah. Well, it's nice to make money, isn't it? You know, so that's why we're here. Yeah.
Thanks,
And also, we've given ourselves an easier task going ahead because we haven't got so many trades to manage. You know, we want to build up to a portfolio of 20 stocks, but we want it to be 20 stocks that we choose to have, and they're in different sectors and everything else. So I don't mind. As I say, we can never go broke taking a profit.
Good point.
Okay.
Thanks, Jeff.
Right. Thanks for joining us. Sorry about the technical issue at the beginning. I have no idea why it wouldn't share anything except a whiteboard, but there we are. I will put the video out of this tomorrow, and it's good night from me. Thanks very much.
Cheers.
Thank you,
Hi,
Jeff.
everyone.
Thanks, Jeff.
Thanks, Jeff.
Cheers.
Cheers, Jeff. See you later, everyone.
Bye, everyone.